Hi everyone, this is Terry with Futures.io, and it's my pleasure to welcome back Linda Bradford Raschke for today's webinar, Reading the Tape. During the webinar, please feel free to type your questions into the questions box, and we'll do our best to answer them at the end of the event. If you're watching this on YouTube, please do us a favor and give us a thumbs up if you enjoy the webinar. And as always, please feel free to share, comment, and subscribe to our channel. It really helps us a lot. For trading news, events, and information, follow us on Facebook, YouTube, and Twitter using @Futures.io. And without further delay, I will hand it over to Linda, and you should get the pop-up to share your screen again.
Okay, gang, can everybody hear okay? And is everybody seeing my main screen? Are you seeing the main screen?
Not yet. You should have the pop-up. There we go. Perfect. Looking good.
Is it showing the correct slide here?
Yep. Looks great.
All right, gang. So let me just start off and say it's been a while since I spoke to you or for Big Mike's website, and it's always an honor to come back. At this point, I've done a series of webinars in the past that have dealt with specific trade setups, trading methodologies, styles, and so forth. So I didn't feel it necessary to go into any great length on technical, since I know that you guys are all pros by now. But what I will say is that I just want to give you guys some pearly words of inspiration going into the new year. One of the things that I continue to get questions on and see around me is that people still are all over the board, lacking consistency in their approach, in their trading styles, as well as having so many distractions in our universe these days. Oh my goodness, I have like one little Skype group that's just 2 buddies online, and that's about my only contact out there with things. I don't have a TV, I don't look at blogs, I don't look at Twitter, I don't look at all that kind of stuff. But I have noticed so many people around me that keep on saying, gee, will you mentor me? Which I don't. You know, do you sell courses? Which I don't. All these different things, which I don't do. But a lot of people are reaching out for help, and this is even people that have been trading for 3 or 4 years. So hopefully what I'm going to do is just today focus on 2 things. I want you to examine your processes, and for that we're going to look at the ways that we go about our initiation, our entries, as well as our exits, styles of exits. So that's going to get you just thinking about your process, and then some things to get you thinking about your concentration levels, because I think if you can get a consistent process down and your concentration up, I think you've got the golden key for success. And obviously there's such a ridiculous amount of opportunity in the markets these days between different assorted stocks as well as futures, the average ranges in crude oil and natural gas and gold and currencies and copper and everything under the sun. There's stuff happening every day. So I've never seen more opportunity out there than we have now. But part of that opportunity is coming because of volatility. And you know as well as I do that that creates anxiety, tensions, stress, emotion. So it's a double-edged sword in how we go about things. So let's just start talking about something. And I wanted to leave plenty of room at the end for questions, or if you have a particular market you want to look at and so forth. Terry's going to take questions at the end. I read a wonderful book by Richard Feynman earlier this year. It's called Seriously, You're Joking, Aren't You? And it's just a wonderful book, and I loved this little picture from it. He won a Nobel Prize in physics in 1965, I believe it was. Just brilliant mathematical mind. And I love this little quote. I have approximate answers and possible beliefs and different degrees of certainty about different things, but I'm not absolutely sure about anything. And that's how we'll best approach the markets when we operate, is that there's no certainty whatsoever. You know, we can change at every fork in the road. It might appear something's breaking out, but then it has price rejection or finds support and rallies back. And so really what happens is that when we let our guard down or drop the ball, be it with trade management or missing an entry, it's costing us not only serious opportunity cost, but in the land of unlimited unforced errors. So I wanted to just talk about why we would do discretion versus systematic and the pros and cons of each. Now myself, I would love to do discretion on entry and discretion on exit with absolutely everything out there because I'm a control freak. However, I also know that I can't trade so many markets that way. It's impossible because if you're using discretion on your entry, it really involves some tape reading or some fine tuning, even if you're just, you know, putting in a buy stop. And same thing with your exits. You're very limited as to the number of markets that you can trade or process. And most people really do best following just 1 to 3 markets at the most with a trade on at any one time. But I do recognize that with stocks, the universe is so much greater, and people always like to bite off more than they can chew, which can lead to trouble. So the discretion part is wonderful, but it also can cause a lot of stress and anxiety, especially in high volatility times when you get too many things going on. So right off the bat, just recognize that everybody's going to find their balancing point as to what you can manage. If you're dealing with a shorter term time frame, it behooves you to use some discretion either on entries or on exits, at least one side. And the reason is because more often than not, we can get better trade location. So in a shorter time frame, trade location becomes increasingly important, right? And same thing in very noisy markets, trade location becomes increasingly important. So to give you the flip side of the coin, if you're trading a long-term trend following system, trade location is not important. It's much more important to get the trade on. And one of the things we would do when we're testing for longer time horizon trades or longer term systems is we test for decay in the signal. So for example, I want to know if I'm trading a long-term trend following system, what happens if I initiate that trade 24 hours later? And I better see a positive expectation. In other words, I don't want the profits from that system to be dependent just on that first day of initiation, you see? So the short-term trading, of course, is the opposite. A lot of times we do get our initial windfall or profitability in a very short time horizon. So the discretion on entry or being fully focused right there can be of increasing importance. Now, we're also going to look at times where you can use a systematic approach for entry and perhaps discretion on the exit. So we'll look at cases where it demands each one. But I'm sure that all of you have experienced throughout the course of the year assorted unforced errors, if you will, that tends to take away from our bottom line more than we would care to admit. And an unforced error tends to be cases where we get reactive, perhaps we missed our entry and we end up chasing, or we have human biases, behavioral biases where we only like to trade gold from the long side, or we only like to trade this market from the short side, you see? And these things can also lead to unforced errors or taking marginal trades. So that's part of the equation, is we want to create a structure and an environment and process where we eliminate those unforced errors. And on the other side that people don't talk about, and I hesitate to talk about it here, is where we can really tee it up and increase the leverage. All right, very important in the big scheme of trading to be able to capture 1, maybe 2 trend days a month that can make up 80% of your profits for the month, or trade with larger size. And the temptation is to want to average trades that aren't working, or jump in and be aggressive in the wrong spots. So really, you need to have a very consistent process and profitability without these big unforced errors before you even think about increasing size. But in the long run, that's where you're going to make your money as a trader. And I'm not talking about making $3,000 or $10,000 a month just paying the rent. You know, I'm talking about making the money where you can put your kid through college and so forth, and sock some good amount away from retirement. And honestly, I think about 2% of the traders hit that point. So 2 parts. The concentration and process is good for achieving the initial consistency and eliminating unforced errors. But really, it's maybe that 1 out of every 100 trades where you can increase your size and really hit a home run. I don't know about you guys, but I love Arnold Schwarzenegger and his quotes, because he speaks so much about concentration and focus. So I know that he wrote a book years ago, if you read that, but there's numerous quotes as well, and so many of them pertain to concentration. And most people nowadays have lost the ability to truly concentrate because our brains are getting hardwired, okay, hardwired with this Twitter and these alerts and these beeps and all these social media things that disrupt the patterns in the brains. It's proven, you know, it becomes an addictive thing like the mouse. And if you think about like what it took for the top athletes, the Tiger Woods, the top tennis players, or whatever, to achieve, you know, their success, a good part of that is from concentration. So you guys all know your own strengths and weaknesses in that area. So I'm not going to say anything more, but I think that it's going to be very dependent on your success in the long run, learning how to tune out distractions and so forth. So what really is concentration? Right? It's staying in the present, staying in the moment, staying fixed on our game or methodology or system or market that you're trading. And you might find that you can really only concentrate for 15 minutes, and then your mind starts wandering, or you're tempted to open the email, or you're tempted to look on your tweet deck, your Twitter deck, to see the news that's scrolling by. And I see so many people get distracted with news. I really don't feel it's important for trading on a short-term basis unless you know that there's some announcement coming out. But I think that from what I've seen, I'm just giving you my personal observations and bias, I see it cause far more harm than good. So assess that with yourself, all right? Let me just see if I go back here. So yeah, I wanted to get back on, just say one last thing with the concentration. It doesn't mean that you're tape reading every tick or staring at every 1 minute bar, and we can't do that. You have to learn to turn it on and turn it off. So we're going to look at some examples of when and how you could really zoom in, or perhaps stock right around those key decision point areas where perhaps price is approaching a level that you find of interest, the previous day's high or low, or perhaps a volume node, or some type of significant structure. All right, so it's your ability to zoom in at those points, and everything else is out of your head, and you're either watching the tape or the chart, a short time frame, or setting up the structure. thinking how you're going to make your next move. So it's also that ability to turn it on and turn it off. I have a great friend, Terry Lieberman, who has this window trader program that's a market profile type of software. And he's telling me that the studies show that you really can't do max performance for more than 90 minutes at a time. So nobody would expect that you can sit down in your chair and just boom, concentrate for 6 hours straight. So 90-minute blocks is a good way to think about breaking up the day. But we want to be able to concentrate at the market opening. You're only going to be able to do that if you've done your preparation and homework. And Lord, he knows I'm not here to lecture anybody on that, because I've said that stuff enough in the background and enough over time. You know, but with that said, I feel like I'm a broken record at sometimes, because I still see people around me who are friends who've been in the markets for 5 years, and I can't tell you how many times they're coming in flat-footed the next day. Well, gee, why didn't you do your homework or your game plan last night? Oh, you know, I was out with my friends and da-da-da-da-da. There's always an excuse, and it's never been a priority to make the trading the all-consuming thing. And then they wonder how come they're not doing better on the year. And so I don't want to lecture that, but man, you know, you guys get my frustration when I hear people whine. So it's really concentrating. For me, what are the main things? Increase in volume, increase in volatility when the market's increasing its overall activity level. I like the swing highs and swing lows. So there's moving averages. So it's really once you're approaching that key level where you're looking to initiate, or perhaps you have a breakout, and when you reach those points, everything else needs to disappear. You know, you need to have no noise, no phones, no dogs, no kids, etc., etc. And here's the funny thing too. I mentioned I have 2 or 3 friends on Skype. They're people that have been trading for 15, 20 years, right? And I was teasing one of them, and I said, okay, so tell me, I want to know, you know, what, you know, we were talking about their different ways of entering and stuff. And he flat out admitted, he's like, well, I'm late sometimes because I'm typing into Skype, you know? So it's like, get your priorities straight. Is it more fun and distraction to type into Skype or a chat room? Or is it better to be right on top of that trade when it's ready to turn or ready to go, ready to break out? So I find that a lot of times people end up chasing because they missed their entry, and you're better off just to let the trade go, regain your focus, and put it out of your mind. Move on to the next one. So I challenged my friends to spend 1 or 2 days to write down everything that causes them to lose their focus needlessly. You know, the TV, the internet, phone, whatever it might be. And this is an exercise you can do for yourself. Just it's like a female being on a diet and writing down how many times food pops into your mind. You know, you don't realize it until you actually start to keep track about it. So, all right, so back to the discretion on entries, the pros and cons. Definitely aggressive traders do better with discretion because you can be right on top of the price. I tend to use market orders for entry on just about everything, maybe 90% of my trades. I use market orders for anything that I'm tape reading or watching. Other people can use buy stops or sell stops at bars. We'll look at some examples. But aggressive traders do better with the discretion on entry. But here's this. They also are much poorer at their trade management skills. Isn't that funny? Because you can't watch for an exit the same way you watch for an entry. So I like recommending a combination, and we'll look at both of these, where if you're using market orders for entry or discretion on entries or working a bid, okay, to get it initially, Then with your exit, I want to see people be more systematic, learning how to bracket markets, OCOs. At least you have a resting stop and a target, but they're easy to move up and down, okay? Whereas traders who are more conservative, meaning they hesitate to pull the trigger, they'll do better with a resting buy or sell stop, perhaps just above or below. It could be a 5-minute bar, 15-minute bar. I want you to start thinking about these things and the way that you're going about stuff, all right? It's your process in your actions on how you're entering. And the more consistent that you can become, the more size you can do. But you can't increase your size, which is where the real money is made. You can't increase your size until you have a consistent process for your entries and a consistent process for your trade management functions. So here's several ways that traders initiate using discretion versus systematic. And I'm sure that you guys know all these, but just ask yourself how many times you're doing combinations of both, and have you really thought about which type of order to use in which type of environment? Obviously, people love short-term flags. By short-term nowadays, I'm talking about 2 minutes, and that's for that first window of opportunity. 7:30 to 9 tends to be Central Time, so 8:30 to 10 in our East Coast time really is the sweet spot where the markets are moving with the most urgency and the most volume. And that's about the only time you get these nice little 2-minute flags. Then you might get a little 5-minute consolidation, and that's it. The market moves are very efficient nowadays. They pretty much are going to keep going straight up and straight down, as opposed to the way that they used to trade 15 years ago with a lot more pauses. Because once the horse leaves the barn, you know, the market tips its hand. So I'm fallen into the category too, the tape reading off a quote board. I'm very used to watching last price. That's supposed to be net change, not net chance. Although sometimes it could be net chance in volatile markets. But I'm very much watching the net change, and I'll tell you how I do that. I have one friend who likes to watch the ladder or dome, and he's about the only person I see much success off of this. The problem is with a lot of the numbers jiggling, and it triggers all kinds of stuff in the brain. I find that a lot of people tend to get super reactive. And you guys know darn well the volume means nothing on that dome. It's all icebergs and hidden and mythological false bids and offers. So don't ever read anything into the size on the dome, because I'll tell you, when I had my fund, we'd always use like random time slicing, random size, you know, to initiate, and you can't see these things working, but they're there in the background. Creating structure with short-term candlesticks, obviously everybody's aware of like this price action thing, and we'll look at some examples of that. I skipped ahead here for you. I didn't want to get too boring. And then lastly, the most mechanical way of initiating would be, for example, an ATR function in the case of mechanical systems. For example, volatility breakout system. Very instructional to learn the dynamics behind that. I've got an article that I wrote on my website on volatility breakout systems under resources if you haven't. Do I trade one? No, but I have in the past, and it's a very constructive exercise for getting you back on track if you have been deviating or getting all over the place. So an ATR function might be something as simple as take 100% of the previous day's range, add it to the previous day's close or the current day's opening, and voila, the market pulls you in. So this was Larry Williams' original methodology, and Toby Crabell popularized this, taking the move off the opening stretch. So I do believe that there are far more efficient, sophisticated ways to play this game now, but with that said, these old ways still have a positive expectation. Okay. And lastly, the case for 100% systematic. I think this is everybody's fantasy of having a little printing press, you know, that can run automated in the background while you sit on a beach and drink your coconut drinks. But if you are wanting to approach a 100% systematic thing, and we're not talking about doing the algos, the high frequency trading off of the minuscule tick charts, which is a different game entirely. Generally, the longer the duration of your trade, the more mechanical or systematic you can approach it. For example, if you're a stock trader and you want to put on a trade, it's some type of pullback and you're looking for it to rally back up for 3 or 4 days. You can be more systematic or mechanical in your initiation, such as buying the high of the first 15-minute bar or something that creates structure for you. Another case for being 100% systematic would be if you are working multiple markets at one time, for example, like the volatility breakout system. And lastly, where you can think in concrete actuarial terms, and by that I mean these probability grids. For example, we used to have a trade that we would do for about 2 decades that was based off of Bollinger Bands the day following a market having big range expansion. So you have your initial range expansion, the market's driven to a new area, and then in the testing process, the price discovery process, to try and establish a value at a higher level, it would do some rotation in the morning session. And we had this automated where you could simply take the first 2 fades of a standard deviation function, such as a Bollinger Band, and then you would cover those trades when it came back to the moving average. So it's a regression to the mean trade as the market starts to rotate and form a small value following a large standard deviation move. So you can play that type of game on multiple levels as well, but it has to have super strong sample size behind it and some really good modeling, and then that's where your actuarial type of trades can come into play, and you could do them on a mechanical basis. There's just not so many of those around. Let's just talk quickly about exits, and then I want to start looking at some charts and move on. I've got plenty of time for questions where we can look at individual cases. Exits. I know I'm not telling you guys anything you don't already know. The people on Mike's website are super sophisticated, trading futures for many, many years. So I definitely am not talking down to anybody. I'm just giving everybody a little reminder, hey, let's clean up our game. Let's get consistent. Let's think about your processes as you start to go into the new year, and think about the markets you're going to trade or the game plan, what worked best for you last year, what didn't work for you last year, and hopefully you can clean up some of these small areas. So exits. All right. It's so easy to enter a market, right? It's never a problem getting into a market. It's always a problem getting out of a market, especially if you have to, and really especially if there's no liquidity. So the signal to initiate a trade is so much stronger than it is to exit a trade, which is why this continues to be a problem that plague people. Usually the exact point to exit a trade is not as well defined. So we're either going to be looking at things such as if there is a tell from the market, meaning a buy climax spike, sell climax spike, could turn into a price rejection spike. It could turn into a momentum divergence, a loss of divergence. That would be everybody's dream come true. Well, we'll just take our profits on little 15-minute buy and sell divergences. But you know as well as I do, the market doesn't work that way, because this market is full of noise. right? So these things are like little unicorns out there. They sound good in theory, right? They sound good in these little bogus textbooks that are written, but there's a lot more noise out there than people care to admit. But that is nice if you do get a signal from the price action itself telling you it's strong enough thing to exit. Also targets, such as if you're looking for a regression to the mean or back into a trading range, these high volume nodes make attractive areas to exit. You know, the markets come back into its equilibrium point. Swing highs and lows are always excellent areas to monitor for exits, and especially if you drill down and you look at 1 minute and 3 minute charts where you have the volume accompanying the price bar or either at the bottom of the bar, you will see it's amazing how much increase in volume have right at these swing highs or swing lows. And I know there's little algos that run teeny buy and sell stops off there, and they're just hoping to goose it a couple ticks and they trail a stop super tight. Why do I know this? Because I have a friend that does it. He's in a $1 billion shop and they are playing this game. And I figure if they're playing this game on an automated basis, there's a lot more other folks playing this game with billions of dollars. So all you have to do is study the volume that comes in at these little intraday swing highs and swing lows, and perhaps they show up on an hourly chart, and you'll see darn well for yourself. So those are excellent opportunities to be prepared to exit into that goosing in the volume at those points. Moving averages, that's a give me. That's just a regression to the mean. Some people out there, I don't know many, claim they like to play for small number of ticks. I have a friend that's an Al Brooks aficionado, and he swears that this guy makes 20 trades a day exiting for 2 to 4 ticks. I can't speak for that, but you could, in theory, make a lucrative living just trading very short-term pieces like that, because your win-loss ratio is going to be so much higher. You know, it's just always the case of not getting whacked too much as well. And of course, any trading strategy is not going to be worth its salt unless you can do it consistently on bigger size. So that's your key that you're shooting for, is increasing your size. I'm pushing you guys to think about increasing your size, but you can't do that until you have cleaned up your act and seen where your Achilles heels are from the last year. Okay, let's just talk quickly about some OCOs, trailing stops, so forth, so forth. They sound great in theory. Now, let me tell you, the whole goal of a trailing stop is to keep you in the market. The whole goal is to keep you on that one trend day, but 90% of the time it is not going to pay to trail a stop on a intraday chart because the noise level is so high. You have to be acutely aware that it is breaking out, and it's going to be a bar like nat gas was today, natural gas, or, you know, I mean, there's always something happening pre-FOMC, right? I mean, that's the great thing about these markets. There's always something somewhere. So, you know, in those cases, it doesn't matter what trailing stop you use, they all should keep you in. It doesn't matter if it's trailing a moving average or parabolic or what the case may be. On the flip side of the coin, if you thought that bonds were breaking down today in front of FOMC, and they did trade down pretty low, I think we got down to 152.04, something like that, and now they're 20 ticks higher, which is actually pretty significant. That's some good change. You wouldn't want to be giving back more than 50% of your open profits at the very least. So, you know, they have a purpose as well of not, you know, letting you get too far out of hand in something. So in general, the trailing stops are really there to keep you from taking your profits too soon. It's not necessarily the greatest exit strategy. I am in favor of working bracket orders, and you can tighten that stop up. I'm going to show you some great examples on a chart as the market moves in your favor. Cinch your profits. That's Taylor. You guys all know that Taylor is my hero, and he will say, as the market moves, cinch your profits, tighten those stops up, don't give them back. You know, profits are like eels, how easily they slip away. Okay, one other thing that I use a lot, I use time of day exits. So a lot of times I'll look to exit around Europe close, usually plus or minus 30 minutes. You know, you can see the euro currency made its low in the morning session just before, actually fairly before the Europe close. Same thing with the gold and the silver and so forth. So I usually break my day up into 4 segments: Asia session, Europe session, then US morning session, which starts at 7 a.m., and then US afternoon session, which is after Europe is closed. So this is another thing I want to talk about briefly, is chunking our data, breaking things up into some type of consistent structure, because the markets are so abstract, there's so much noise, so much sensory overload and so forth. You're gonna have to come up with some mechanism, no matter how artificial it is, to chunk your data and break it up into manageable stuff. Otherwise, you're just gonna melt all over your keyboard. So time of day function, just keep that in mind. And then lastly, we're gonna look at bracket orders and how to use some of those. So back to the main point, this consistent process, acting consistently, learning to think consistently, because it was funny too. I was talking with my buddy at lunch today, and he's, you know, one of those mathematical genius minds that still knows how to use words bigger than four letters. You know, I can't say the same for me, but it's not just the acting consistently. It's not just the consistent doing. It's also the consistent thinking. And you can see, I know from myself, I've been in the markets now for 36 years, and it's very easy if I fall off the wagon, if you will, if I have disruptions in my daily routine. For example, I just drove down last week from Chicago to Florida, and I did it in the middle of the week. So I'm out of sync with the markets. You know, I'm trying to get reorganized, all this type of stuff. And it's very easy then when you sit down, thoughts come into your head, biases come into your head that might not be there if you were sitting in front of your screens day after day playing your little game. So the acting consistently is a good part of it, because that's where our habits come from, of course. But thinking consistently, the process, in other words, when you're looking at the charts, are you starting with a top-down approach? Are you starting out with, here's the daily bars, and now let's look at the breakout of the first hour's range, or let's look to see if this is going to be a rotation consolidation day after a big market move yesterday? Or have we had 3 days low to high in crude oil, and today there might be a chance, if it fails above yesterday's high, for a reversal back down to the hourly moving average or something like that. So it's the consistent process of following your roadmaps. Personally, I like to follow a 30, 60, 120 minute type of roadmap, even if I've got a position on for 2-3 weeks. I love those 120-minute charts. It eliminates the noise for me, but it gives me something to follow. And so it helps me, it's not just the action of how I'm going to initiate or manage the trade, it's my process in thinking. So, and then lastly, you know, I mean, you guys know a zillion sports analogies, you know, just keeping the ball in play. You know, it's so rare that we actually get that opening for a big win. I think that's what's frustrating for a lot of people. They don't realize that, you know, all you need is like 2 or 3 really great days a month, but you can't force those things, and you're never quite sure where they're going to be or how they're going to unfold, and that can really make your month. But it's not going to happen if you've dropped your concentration, if you're bored and distracted, you start surfing on the internet, reading Zero Hedge, or all these things that are out there that are just pure evil, in my opinion. So let's just look at a few examples, because now I want to talk about specifically about ways to tape read the entries, things that I use, things that some of my friends use. I wouldn't mention them if these people hadn't been in the markets for over 15 years and have been doing this full-time professional for many, many years. So it's the process that can work for different people. What might work for one person is not going to work for another. So I just wanted to show you several ways of going about things. I picked nat gas today because everybody's thinking like the market was such a sleeper, but there's always something happening. And coming in this morning on nat gas on my trade sheet, and I know I've got examples of that in previous webinars, so I'm not going into the big picture strategies here. All I wanted to show you is that we had this lovely little kind of bear flag still. It looked like we could retest that swing low. So that's all I was thinking about coming in during the day. And this is just, if you're just a morning trader, if you just had to stick with one strategy and that was it, I would just say look for this 8:30 to 10 o'clock window that is such the sweet spot. Please don't lose your concentration during this window. And I guarantee that out of 20 markets, 3 of them are going to have wonderful little short-term flags. It's probably not going to give as much all the time as this nat gas did, but I wanted to show you this is what your entry looks like. I don't use this, but this is what my friend uses, and he does a lot of stocks. He does a lot of options, the weekly options on stocks. So you know those things, you got to be super tight on top of those suckers. And he's not going to make more than 1 trade at a time, 1 or 2 trades at a time. He'll never have more than 2 really working. But he likes to go down to the 2-minute chart, God bless him. So that is a tool for you to look for these urgent moves. And after a market breaks out, you almost always get 1 little pause on the 2-minute chart before it continues. So this would be a way of initiating off of a very short time frame. We call them the TTFs, the tiny time frames on this type of chart. Now you don't know what the market's going to give. You're just looking initially for a test of that previous little low that was just made, you know, perhaps right here, like a new leg down. And of course, a savvy trader's always keeping those big picture highs and lows in the back of their mind. For me, I like to look at that 120-minute chart. So this is one way of initiating that takes concentration, being right on top of that. But if you're right on top of that, you know, you can bang out a 10 lot with a lot of comfort, feeling secure. Now this is the board that I look at during the day when I'm trading. I have charts above me, but usually I'm just trading off of this net change here. So when I'm looking to make a trade, I'll be looking, for example, the bonds are down minus 11 ticks. The S&P's plus 625. If I'm watching these and I'm looking to sell, I want to see it go plus 625, plus 650, plus 650, plus 675, plus 650. I want to see it stop going up, and then I'll pick my spot. So for example, earlier in the day, I just put up a tick chart here of this natural gas. This is probably the equivalent of like, this is that 2-minute chart. I just expanded it with ticks, but I'm looking at the price and I'm thinking to myself, it's too many numbers usually for me to sit there and think like 2780, 2781, and 2782. Instead, I'm looking at minus 60, minus 55, minus 54 as it's bouncing, and then it'll start to turn, and then all of a sudden it goes, minus 60, and they'll usually be at the market. So I'm very much a trader that trades off of this net change, and that's just strictly because I was an options market maker on the floor. When I started out, we didn't have charts, so all I had was net change. So that's the way I process data. I have to see that net change start to reverse, and that's the way that I can usually follow a lot of markets at once. That's not for everybody. I think that's harder if you've just come into a land of bar charts. So with that said, I put up 5-minute candlesticks. Now I know that this price action trading, or whatever it's called, I've heard it called numerous things, where you're either looking to put a sell stop below the low of the 5-minute bar, or a limit price to short above that. You know, there's all sorts of little structures and funny terminologies and so forth for that. So I do have some friends that use that to initiate. So the nice thing about that is, okay, we had a big down on this bar showing the breakout from this bear flag thing. And you can put in a sell stop and let it pull you in. You know, there's pros and cons. There's always noise levels around these things, but I have a lot of friends that like to initiate using that sell stop below the low of the 5-minute bar, or vice versa. It's not for me. I don't do it. I'm just showing you different ways to do things. And then lastly, for market profile people, I don't have a profile chart up here for you, but same type of trade, framing this out, just looking for the break from this initial balance area. This here is your 8 a.m. opening, which I like to use East Coast time for just about every market. It's how I orient and center myself. All right, so you just see different ways of processing data. All of them demand some concentration and focus right at that time of entry. Once you got your trade on, though, you're going to put your stop or your working bracket in, and then you got to chill and step back, because you can't be watching every single little tick. What happens is, if you're watching every little tick and you're zooming in on too tight of a time frame, you're going to get jiggled out by the noise. You're going to have uncertainty. So you always have to keep that big picture in mind, even if, I'm just going to go back, even if it's just this little short-term flag, I have to sit there and think, okay, we got to at least go down and test that low, you know. And then you can see this was the break of the previous day's low down here. Okay, you know, so you can trick yourself. Okay, let me see if we can trade back into the range of that previous bar, you know. And obviously you've got a lot more tools at your disposal with multiple time frames and structure and so forth and so forth. So you get the idea. Pick one way and do that consistently. You have your initial game plan coming in the morning. Maybe you're doing breakouts of 3-bar contractions or 3-bar balance points. Maybe you're entering once a market is in play. On the stock, I'll tell you, my absolute best signal this whole year for stocks has been simply looking at a screen off of my trade station, which gives me an alert for the biggest 5-minute bar. The biggest 5-minute bar off the opening price. All right, and that's the thing that's in play for the day. I mean, I've never seen it be as lucrative as it has been this year. So it doesn't mean it's going to be that way next year, but the point is that, you know, it's a consistent signal, a consistent process, and that's where you want to go with this. Now, I just wanted to show you too. I have one friend that trades off the charts. I personally prefer just to use my last price, but TradeStation has the trade off the charts. This is actually Photon Trader. Almost all programs now have a simple ability where you can trade off the charts. Now, I like the numbers and the data. Some people like the visual, so the spatial relationships make sense to them. So this was a nice little trade. And the euro currency, it had made a bottom. It put in a higher low here, and you could see there really wasn't much volume. These are candle volumes, so the width of the bar equates to the volume of the bar. So this is a big flush right here. You could see that we had been dribbling down throughout the morning session ever since, Europe opened, and then we dribbled down. And then here you're getting a little bit climax, and then you had to get down to this area where the volume was drying up. You see, this is just a stupid 5-minute chart, and I know the currencies are in the middle of the roll in a couple days, but it really is not going to affect the volume on 5-minute bars. And so, they put in a higher low here, so we just thought, okay, let's see what we get here. So you've got a stop and a target here. So that's one way. That's just a simple OCO. That's one way of managing your trade. And now you can grab this and drag it up, or if I grab it and drag it down to here, it'll just turn it into a market order. So sometimes it's more fun for people if you make it more like a video game. Now here's another way of doing it. I've got in a stop on a 4 lot here and an exit and an exit, so you can scale out, right? So that's, ultimately this market rallied up to like 117.50. We rallied up to here at the end of the day. So you might want to stagger and say, let me take a piece around here. If it's starting to act very steady, you can always raise this up. You can always, close the whole thing out at any time, but at least you're making it into a structure and a game that takes the emphasis and the stress off of not having stops, not having trade management, not having targets. And I'm saying that because I'm still stunned by how many people don't have organized structure or game plan in their trading. It just, and then they're all anxious and emotional, and they don't understand why. Now this is another type of order. It's a bracket order, and this would be in the case, let's say you didn't have a position on and you wanted to sell here, to short here into that tail area. Once your trade is hit, okay, then you can see over here on the ladder, I just put this up so it show what it looked like. You can put it so there's an automatic bid and an automatic offer for a stop. So either way, once your trade is hit, you're going to be working an exit strategy. And this is 100% mechanical. I don't trade this way, but I will tell you one thing. I had these 2 French interns come to my office 5 years ago, and they were supposed to be all hotshot, hoity-toity, and so forth, and they were really annoying me because they drink really late at night downtown Chicago. They go to Chinatown and get sick, and they're little scrawny people, so they couldn't hold their alcohol anyway, and they're supposed to be getting their MBAs in finance and all hotshot, right? So I was like kind of irritated. I'm like, I just don't know what to do with these 2. So I turned it into a contest for them, and I made it that the only charts they had were off this photon platform here. You can use 60-minute or 5-minute or whatever you want. You can put up Bollinger Bands or whatever. So I turned it into a contest for them. I said, okay, you guys have 4 weeks. You can't trade more than 20 lots because we were on a simulator with them, and I didn't want it to be like where they could jack around a 50 lot and think they're real hot, but I said, okay, you guys can only do 20 lots, and you guys have to each come up with your own style of trading. And then at the end of like 4 weeks, whatever it was, you're going to do a PowerPoint presentation on what you did, and you're going to present to me your results. And gosh darn it, this was really annoying because they both made ridiculous amount of money, and I was like, wait a minute, these are 2 scrawny kids who are drinking late at night. What are they doing right here? But what they were doing right is the one kid was only doing the S&Ps, no other markets, and he was tending to do a mean reversion type of strategy, but he would stay out of the morning market when you would have the volume and the noise. And then around lunchtime, he'd watch it, and he would do exactly this. He'd put in an offer, and if it got hit, it would automatically place the bid to cover on a reaction. And dang, the kid was killing it. And what was so funny is his partner, his buddy, I won't call him partner, they were drinking partners, I guess. His buddy was sitting there and doing almost the opposite, looking for that momentum move in the morning and going with the market. He was using like an MACD or something, and he traded 3 markets like gold, EC, and S&Ps, kind of doing the opposite of what the other one was, except he was taking advantage of the morning volume. So the moral of the story there is that each of them were pretty good about having in their little trade management. They were just doing it off of the charts, and they were each concentrating on just one type of style. The one was doing mean reversion when the volume died and just playing off the noise, and the other one was looking to the go with where you had the increase in volume. 2 opposite styles, and they just concentrated on their game and did a-okay. So the last words I want to say on concentration, because I think you got my message by now, and that is you're going to always do your best the better prepared you are. So you want to be a trader. I mean, everything has to come first, you know, with the markets. You know, I don't want to make it sound like you got to eat, sleep, breathe markets 24 hours, but you have to make it your priority that you got your game plan, you've done your homework. I have something where I send off my same trade sheet that I've done for like 30 years, and I know a lot of you have seen it. So I send my same trade sheet to a buddy, and he sends me his, and then that keeps me accountable. You know, I don't even look at his. He just knows that he has to send it to me. I doubt he looks at mine, you know, but it makes me do it. You know, I know I have to do it. And so you can come up with little you know, routines or processes like that that keep you accountable, and you know that you have to get your game plan off to your trading buddy or whatever it is on a daily basis. There's, you know, a million little tricks you can do, but you're not going to be worth much unless you've done your homework and your game plan. It might just be as simple as printing off a 5-minute bar chart of the NASDAQ futures the day before and circling key levels that you want to look for, all right? It's always easier to be watching price relative to another price, be it a swing low or a value area or whatever your modus operandi is. You have to have an initial departure point. And then it's always tough when you're stressed or emotional. I just don't see people having much success when they recognize, you know, that they're under the gun and so forth. So just be aware of that. And with that, I don't want to belabor anything. I just wanted to leave a little bit of time for questions. And again, just to sum up my main points: consistent process in your actions, consistent approach to the markets, and consistent way of thinking. And then from there, I think that concentration can get you where you want to be. All right, so with that, I'm going to say, do you have questions for me, Mr. Terry?
Yes, I do. Give me 1 second.
Oh, I got something really cool here too. Look what I can do. I can...
Let me see.
See what I can do? I can pull stuff down onto the board here. We could have all kinds of fun.
All right, let's see. First question is, what is your thoughts on Bitcoin? Have you traded, or are you going to trade it, or stay away?
I think that anytime you have a new market, there's tons of opportunity because there's an increased degree of uncertainty, right? Nobody knows. I mean, you know, today the stories were this site was getting hacked, this site was getting hacked, but you know, it's out there, and it's got a lot of volatility. So it's a fabulous trading vehicle. On one hand, I don't know about the liquidity doing size. I haven't tested like stops or anything like that. And I'm not one of those people that makes a prediction what's going to happen a year from now. I just don't believe in that stuff. I mean, it may or may not be alive or around, or who knows. But you know, if you want to just watch Bitcoin markets, it might just be that type of market that takes all your concentration. you know, of course you got to go make a trade just for fun, for the sport of it, but am I going to make serious profits in it? No, it's not my game. I mean, I'm trading my, you know, crude oil and nat gas and gold and silver and bonds and that kind of stuff. So that's my game. But I just think it's a, you know, it's a market that's moving and it's going to have nice emotional swings. And if you didn't get a good night's sleep, I'd probably stay away from it. There you go.
Let's see. Have you ever evaluated and or used any of the order flow software tools currently on the market?
I've looked at them. I've had a chance to look at them over the last year, over the last 4 years. Honestly, they do zippo for me. Because you will notice that there's a pretty high correlation between the increase in volume. When something's making new lows on the day, let me just give you a good example here so you can relate to this. Let's just see. Let's see here. Trying to find a good market that was moving that would be. I'll just go back to nat gas here, but you'll see in general when something's doing this and there's no support and it's making the new lows, you'll always see the order flow being like the bids getting whacked, you know, the most of the volume coming on the bids and so forth and so forth. So you don't really need that software to see that. Then what you'll notice is that when you start to see say for example, a divergence on a 5-minute chart, because you had a previous low that was relatively close, now everybody knows that the market at least had a reaction up off of that low. So of course you're going to see a change in the dynamics between the bid and the ask there. So you'll see a big change in the way that it goes, where you'll see a very high correlation between what might look like an order flow picture versus a little 5-minute oscillator on something. So that's my 2 cents worth. And also, I mean, I know because like when I was a CTA and, you know, our fund, we'd do like 600 lots and I'd set the little algorithm to execute and it would be, I mean, IB, Interactive Broker has these, Photon has these. We set a little algorithm. It'll say do 500 contracts, make it random size at random intervals. I want half of it hitting the bid. I want half of it working an offer, blah, blah, blah. And you set these things loose. You know, it's like when we used to give orders down to the floor brokers in the old days in the pits. I'd call an order down to the broker in copper and say, I need to buy 300. I don't want to pay above this price. Get me an average price over a 10-minute window. And most of the big money nowadays uses some type of time slicing algorithm for execution. So it sounds seductive and you can look at little pretty pictures and textbook things, but truly what's happening is that, yeah, when something's hitting the bid and it looks like all the the orders are being on the, you know, on one side, it's usually because the market's making new 20 bar lows or 20 bar highs. There's no support or resistance, and then once the market has a reaction and it becomes known that the thing's not going to drop like a rock forever, then you'll start to see some divergence in your order flow. So I just find, for me, it's not the basis for a trade. I mean, if you find that it helps you overall in the long run, that's fine. If it's not working for you and it's causing you to miss stuff or distractions, or you're getting caught up in the wrong things, then it's not working for you. I think everybody has to evaluate for themselves, but for me, I don't care for it.
Okay. Any ideas on building discipline?
Building discipline. Oh man, is that an awful word, discipline? Well, so let's go back and get rid of that word and start with two other words: process and habits. Okay, there's no such thing as building discipline if you have sloppy habits, because you're just gonna, oh gee, my habit's to go to the fridge and eat a piece of fudge every hour. Well, that's a habit, and it's not a matter of lack of discipline. It's that I'm being controlled by that habit. So the discipline part for me would be, let's do our homework at night, you know, let's do your preparation for the next day. That's the discipline part. And you can start with that because it's manageable. You're not trading with that, and that's going to be a function of how badly do you want to succeed. You know, I mean, you have to want to succeed so badly that you're going to find a way to do your homework every night, and then you're going to come in the morning, and let's say for example that we notice that our game plan is to, you know, short the bonds at this level and buy the S&Ps at this level, or buy the S&Ps on this type of signal. Okay, so just giving you two hypothetical examples. But now you find yourself, oh, all of a sudden you're looking at silver reacting, and it's like, oh, let's chase that price. And you know, your discipline is falling apart either from making reactive or marginal trades that weren't part of your game plan, or your discipline's coming from lack of stops or proper trade management or averaging losers, which are just bad habits. And so the only thing I can say to that is that Darwinism's going to take care of you pretty darn quickly. You know, if you find yourself to be too reactive and so forth, you have to go back to square one. I would say find a partner or a buddy or somebody that you can be accountable with, and you have to build it up from scratch. Okay, you are allowed to do one E-mini only, and you know, and make one trade a day, and if you're profitable at the end of the week, then you can go up to 2 trades. You know, you need to do some artificial structure like that to keep you from yourself. And you know, we are human, so everybody makes unforced errors and stuff like that. But you know, I would do some research on habits, and they say that to break a bad habit, it takes 20 occurrences of doing the right thing first. And if you try to do too many things, too many signals, too many markets, look at too much stuff, I'd say you're dead in the water before the gate opens.
Okay. Do you scale out with multiple targets? Or are you all in, all out?
I would say that most of the time I'm all in and all out. Maybe 20% of the time I'm all in and then take a partial and you know, try and get better on the second half.
Okay, perfect. Let's see. What market profile software do you use, and do you prefer market profile or volume profile?
I tell you, do you still have this, let's see here. Let me see if I can slide this down. I have CQG, so I just moved it down here now. I have CQG if I'm going to look at CQG. I don't look at the market profile though. I really don't. I would be more inclined to look at a volume profile, only because I like, I'm just trying to find this here, only because I like here's a volume profile thing. I like the big nodes. I like these big volume points here. You can see, I got to show you something pretty funny, because this was in silver in the middle of the day today. It'll come up here. Anyway, there was a little goosing when I think some GOP nonsense or tax bill came up, and this was the middle of the previous range you can see on this, and we went right up to that level there. So I like the volume nodes on big picture, but I mean, they're a very secondary thing for me, and the actual profile, even though I also have Window Trader. Terry Lieberman's a really good friend, so I have that at my disposal. I just find that I don't use it. It's, you know, it's not, I get my information in other ways. It's probably not very helpful, I know.
Let's see.
I think market profile is lovely if you're just following one market, like just the index futures, and it's a nice way of creating some type of structure for you. If you're going to do your homework, you have to do your homework. You have to mark off your levels. You know, you can do all kinds of fancy stuff with it, but you can do just as much with this in other ways as well. For example, I know that people like to look at this 3-bar balance type of sort of feeling, okay, when something comes, like you can see silver's starting to form this now. We got like 3 bars of price overlap just right up here at the top. See these lovely little 3 bars of price overlap. So you can see that as a big fat node on the volume profile, but I can also just see on daily candle bars that I got a nice little tight 3 bars there, and I know that the moves out of that tend to be super choice. So same thing here with the bonds. You had these nice 3-bar overlap down here at the bottom, right? And I mean, it's not always so perfect. And then you had this nice tight 3-bar here, which led to a super break, a super trend day. And that's what I was saying. I really like to be in a position to capture a good trend day down. So today, online, I had a buddy and he's like, oh, bonds are breaking from a 3-bar because you have this 3-bar triangle. But I'm like, nah, it's not a good 3-bar. They got to really, this bar was too big. You see, it's just too big of a range for me. It wasn't the tight little type of node that we like to see for that. So I get information in a different ways, just looking at the daily candles, and then sort of my Taylor rhythm. You know, there's a little bit of pattern recognition with the 3 bars. There's a little bit of pattern recognition with these extended runs. For example, this gold now has been 7 days below the 5 SMA, and I know the first close back up above it would then set up a short sale, that type of thing. Same thing with cows. Cows have been on this lovely extended run down, 1, 2, 3, 4, 5, 6, 7, 8. So I know the first close back above, tomorrow is probably going to be an opportunity for a short. So I have my little roadmap that I create in my mind with these daily candles and so forth. So everybody has to pick their particular strategy or methodology that they're using. And I find that market profiles wonderful for showing certain levels. And I see that the people who use it most successfully tend to pretty much follow just 1 or 2 markets with it. And then if you are not an adept, experienced user with it, I find that too often people will see what they want to see as well. Oh, we're breaking out of the initial balance, but then it can come snap back. So if it has too much gray area for you, I'd say go back to framing out some structure on the bar charts. But on the other hand, it's a wonderful conceptual tool. If you get it that you've got double distribution, or breakout from the initial balance, or however you want to frame it out. Bit of a wordy answer.
Okay, let's see. You mentioned there's a big lack of focus and concentration between your generation of traders and the Gen X and millennial traders. Have you noticed any positive traits from those 2 generations, such as a new way of thinking or different trading approaches, or are they all doomed?
Heck, I wasn't saying my generation was any better at concentrating than our younger generation. I think our generation's getting harder at concentrating as everybody gets more senile. Come on, I think you just have to be aware of the TV, the social media, the distractions that you have around you. It could be the telephone. As far as the younger millennials, I have a daughter who's 29 now, and one of the most thoughtful things I see is that they really do have a sincere, effort to want to be helpful to people around them at times. I mean, I really feel that, you know, there's a little bit more of a take care of each other, take care of the earth, take care of, you know, let's preserve things, you know, type of mentality. I do know that they like the experiences more, the going out to dinner more, the socializing stuff, as opposed to like the cliche 1980s where it was all about things and stuff. And I don't know. You remember that movie, Christmas Lampoon's National? Was it National Christmas Fan? Ah, Nat,
National
National Lampoon.
Lampoon's
Yeah,
Christmas Vacation.
Christmas Vacation. Thank you, thank you. And the icicle goes through the Millennium's window, and they're like, Todd, how did this get here? You know, that type of thing. So, you know, the emphasis on the BMWs and so forth. You know, look at, you know, I've got a nephew who graduated from USC with, you know, applied mathematics and computer science and all this kind of stuff. And yeah, I mean, for sure, everybody has different ways of looking at things, and that's what creates opportunities in the markets, you know. But when you come down to it, I mean, the price is going up or it's going down, period, you know. So you can't really reduce it to much more simple terms than that. And whatever works for you in framing it out is what's important.
Okay, I think we're getting close on time, so I think this might be the last question. Do you have any suggestions on not getting shaken out of winning trades?
Not getting shaken out of winning trades. Okay. Well, first of all, start off and look at all the times that it did pay to get shaken out of your winning trade. Okay, I see a lot of people crying that, oh, I got out too soon, but then I don't see them saying, oh, it was a good thing I got out, right? So make sure you look at both sides of the coin with that one. And then what it's saying is that you've got a little bit of a home run mentality. Okay, so what you're doing is you're playing for that trend day, you're playing for that home run trade without the realization that there's a lot more noise in the markets than you would care to admit, and then you're just getting caught up in that noise. So the best thing you have in your defense is perhaps take half off. Okay, so at least you've locked in something, and then you can use that to say, okay, I'm going to increase my basis. And then the second thing is that maybe you're not meant to be a home run type of trader or a big trend day trader. Maybe there's too many times where you're swinging a little bit more than you should, and go back to being more of a short-term trader. And instead of looking at how much you left on the table or how much you gave back, why don't you add up your profits per trade and see how much you're at the end of the day? So for example, if I'm trading the bonds, and let's say I just take 10 ticks out. I take 10 ticks out per one lot, okay? And I'm thinking to myself, oh wow, you know, I just made $320 or whatever, you know, the case it is there. Instead of thinking, oh man, you know, I should have gotten out when it was, you know, $1,000 in my favor type of thing. So you have to say, how much did you lock in each day? You know, and when we were in the pits on the floors, this was like so many years ago, it's not even relevant. But, you know, we're thinking out, like flipping the options, how many eighths did we make and how much did it add up to the end of the day? You're not thinking you bought the low for the, you know, the day and sold the high for the day. You're just turning it over. You're turning the trades over. So you have to find a way to reframe it in your mind, where the game is not about trying to play for a trend day or a home run move, because that's not working for you if it's bothering you. You know, otherwise you have to like put your stop in at break even and walk away for a couple days and come back. That would be the only way to get around that. So it's a temperament thing, and that's the best I could direct you.
Okay, perfect. Thank you for the information today. Thank you for the webinar, and most importantly, thank you for spending some time with us this evening.
You're welcome. Always a pleasure. I so respect Mike for the site that he's built and the community that he's got on that site around them. Just fabulous traders and fabulous people. And it's, from what I've seen over the years, just fabulous resources. So wishing you all the happiest of holidays, and I'll see you online hopefully sometime next year.
You too. Thank you. Bye.
Bye.